What I'm about to reveal is the difference between building real wealth and staying financially stuck for the rest of your life. Most people think they're investing smart, but they're actually following 4 lies that guarantee financial mediocrity. These aren't small mistakes. These are wealth-destroying beliefs that have been fed to the middle class for decades, and they're keeping millions of people broke. I don't care if this makes you uncomfortable. I care about your financial future. And right now, if you believe any of these 4 lies, you're sabotaging yourself without even knowing it. This isn't about get-rich-quick schemes or market timing tricks. This is about fundamental misconceptions that are costing you hundreds of thousands, maybe millions of dollars over your lifetime. The financial services industry loves these lies because they keep you dependent, confused, and paying fees. Your financial advisor probably believes them too, which is why their advice isn't making you wealthy. But I'm going to break down each lie, show you the real numbers, and give you the framework that actually builds wealth. Let me start with the first lie. And this one is so deeply embedded in conventional wisdom that questioning it feels like financial heresy. The lie is this: diversification means owning 50 different stocks or 100 different investments, or spreading your money across every possible asset class and geographic region. Wrong. Completely wrong. Here's what really happens when you follow this advice. You end up with a portfolio that's so diversified it's worthless. You own a little bit of everything and not enough of anything that actually matters. Your returns get watered down to the point where you're barely beating inflation, if you're beating it at all. You think you're being safe, but you're actually guaranteeing mediocrity. Real diversification, the kind that wealthy people understand, isn't about owning everything. It's about owning the right things in the right proportions. Warren Buffett has said his ideal portfolio would be concentrated in his best ideas, not spread across his worst ones. Charlie Munger called excessive diversification protection against ignorance, and he's right. Think about it logically. If you own 50 stocks, do you really understand 50 businesses? Do you know their competitive advantages, their management teams, their growth prospects, their risks? Of course not. Nobody does. You're not diversifying, you're gambling on a bunch of companies you don't understand. The wealthy take a different approach. They identify a smaller number of high-quality investments and put meaningful money behind them. They might own 20 stocks instead of 50. But those 20 stocks are companies they actually understand. Companies with strong fundamentals, companies with competitive moats. They're concentrated enough to benefit when their best ideas work out, but diversified enough to survive when some don't. Here's the math that proves this point. If you own 50 stocks and 5 of them double while the rest stay flat, your portfolio goes up 20%. But if you own 10 stocks and 2 of them double while the rest stay flat, your portfolio goes up 20% too. Same result, but with the smaller portfolio, you actually had a chance to understand what you owned. But here's where it gets really interesting. With the concentrated portfolio, you're more likely to spot problems early and opportunities quickly. You can't monitor 50 companies effectively, but you can definitely stay on top of 10 or 20. This means you can make better decisions about when to hold, when to buy more, and when to sell. The second lie is even more destructive because it keeps people on the sidelines for years. The lie is this: you need $100,000 or some other large amount to start real investing. This is complete nonsense, and it's keeping entire generations out of the wealth-building game. I meet people all the time who say they're waiting until they have more money to start investing seriously. They're putting small amounts into their 401k maybe, but they're not really building wealth because they think they need some magic number to begin. Meanwhile, inflation is eating away at their savings, and opportunity cost is compounding against them every single day. Here's the truth that the financial services industry doesn't want you to know. You can start building serious wealth with $1,000, $5,000, $10,000. The amount doesn't matter nearly as much as the habit and the time horizon. What matters is starting, learning, and staying consistent. Let me give you some real numbers. If you invest $500 a month starting at age 25, assuming a 10% annual return, you'll have over $1 million by age 65. But if you wait until you have that magic $100,000 and you don't start until age 35, you'll need to invest over $1,000 a month to reach the same result. You literally need to invest twice as much per month just because you waited 10 years. This is the power of compound interest. And it's the reason why starting early with small amounts beats waiting to start with larger amounts. Time is the most powerful factor in wealth building, not the size of your initial investment. But there's another component to this lie that's even more damaging. When people wait for some arbitrary amount to start investing seriously, they never develop the skills and knowledge they need to be successful. They never learn how to analyze companies, how to read financial statements, how to understand market cycles. They're planning to jump into serious investing without any experience, which is like planning to run a marathon without ever training. The wealthy understand this backwards. They start investing small amounts as early as possible, not because those small amounts will make them rich, but because investing teaches them how to think about money, how to evaluate opportunities, how to manage risk. By the time they have larger amounts to invest, they've already developed the skills they need to do it well. Every month you wait to start investing is a month you're not learning. Every year you spend on the sidelines is a year of compound interest you'll never get back. The market doesn't care how much money you have. It cares how long you stay invested and how well you understand what you're doing. The third lie might be the most seductive because it makes people feel like they can control something that's largely uncontrollable. The lie is this: market timing is everything. And if you just get in and out at the right moments, you can beat the market consistently. This is the lie that creates day traders, that sells financial newsletters, that makes people think they're smarter than the market. And it destroys wealth faster than almost anything else. Here's what the data actually shows. Even professional fund managers, people who do this for a living with teams of analysts and sophisticated models, can't time the market consistently. Studies show that over long periods, less than 10% of actively managed funds beat their benchmark index. Less than 10%. And these are people with resources and information that individual investors could never match. But somehow, regular people think they can do better. They think they can look at charts and economic indicators and news headlines and figure out when to buy and when to sell. They think they can outsmart institutional investors and algorithmic trading systems with their laptop and their intuition. It's delusional and it's costly. The math on market timing is brutal. Missing just the 10 best days in the market over a 20-year period cuts your returns by more than half. But you know what happens when people try to time the market? They inevitably miss some of those best days because they're sitting in cash waiting for the perfect entry point, or because they panicked and sold during a downturn. Here's the psychological trap. When the market is going up, people feel confident and want to buy. When the market is going down, people get scared and want to sell. This is exactly backwards. You want to buy when things are cheap and sell when things are expensive, but human emotions push you to do the opposite. Market timing amplifies this emotional mistake because it requires you to make perfect decisions at moments when emotions are running highest. The wealthy understand this. They don't try to time the market. They try to time their lives. They invest consistently month after month, year after year, regardless of what the market is doing. They buy when the market is up. They buy when the market is down, and they let time and compound interest do the work. This approach, called dollar cost averaging, removes the emotion from investing and virtually guarantees better results than trying to time entries and exits. Think about it this way. If you could predict market movements with even 60% accuracy, you'd be the richest person in the world. If professional investors with unlimited resources can't do it consistently, what makes you think you can? The market timing lie keeps people busy, keeps them feeling like they're actively managing their wealth, but it doesn't make them money. It costs them money. The fourth lie is the most dangerous because it gives people a false sense of security about their financial future. The lie is this: your 401k is enough for retirement. This belief is sending millions of people toward a retirement crisis they don't see coming, and by the time they realize the truth, it's often too late to fix. Here's the reality about 401k plans. They were never designed to be your only retirement savings. They were designed to supplement pensions and Social Security. But pensions have largely disappeared. Social Security is under pressure, and somehow the 401k became the primary retirement vehicle for most Americans. It's like asking a bicycle to do the job of a truck. Let me break down the numbers. The average 401k balance for people approaching retirement is around $200,000. Sounds like a lot, right? Wrong. Financial planners generally recommend withdrawing no more than 4% per year from retirement savings to avoid running out of money. 4% of $200,000 is $8,000 per year. $8,000. That's poverty-level income, not retirement security. But the problems with 401k plans go much deeper than just the amounts people are saving. The investment options in most 401k plans are terrible. high-fee mutual funds that underperform the market, limited choices that prevent you from building a real portfolio, and very little education about how to actually use these tools effectively. The fee problem alone is staggering. The average 401k plan charges fees of around 1% per year. That might not sound like much, but over a 30-year career, those fees can cost you hundreds of thousands of dollars in lost returns. You're paying money to underperform the market, which is like paying someone to make you poorer. Then there's the contribution limit problem. Even if you max out your 401k contributions every year, which most people can't afford to do, you're still limited in how much you can save. For 2025, the contribution limit is around $23,000 per year. If you need to replace 70% of your pre-retirement income and you're making $100,000 per year, you'll need to generate $70,000 per year in retirement. Even with aggressive assumptions about investment returns, maxing out your 401k probably won't get you there. This is why wealthy people don't rely solely on their 401k. They use the 401k for the employer match and the tax benefits, but they build wealth outside of it too. They invest in taxable accounts where they have more control over their investments. They buy real estate that generates rental income. They start businesses or invest in businesses that create additional income streams. They understand that retirement security requires multiple sources of income, not just one retirement account. The 401k lie is particularly dangerous because it's reinforced by everyone around you. Your employer promotes the 401k plan. Financial advisors sell products for 401k plans. The government gives you tax breaks for 401k contributions. Everyone has an incentive to make you believe that your 401k is taking care of your future, even when the math clearly shows it isn't. Here's what you need to understand about these 4 lies. They're not random mistakes. They're not innocent misunderstandings. They're systematic beliefs that benefit the financial services industry at your expense. When you believe you need to own 50 stocks, you pay more fees and make more transactions. When you wait to start investing, you stay in cash longer and miss out on growth. When you try to time the market, you trade more frequently and pay more fees. When you rely only on your 401k, you accept limited, expensive investment options. The entire system is designed to keep you confused, keep you dependent, and keep you paying fees. The lies persist because they benefit the people who sell financial products, not the people who buy them. But once you understand this, you can start making decisions that actually build wealth instead of just generating fees for other people. So what does real wealth building look like? What's the framework that actually works? It starts with understanding that building wealth is not complicated, but it is different from what most people are taught. First, focus on owning pieces of great businesses, not diversifying into mediocrity. This means buying stocks in companies with strong competitive advantages, competent management, and reasonable valuations. Second, start immediately with whatever you have. Don't wait for some arbitrary amount. Start with whatever you can afford. The goal isn't to get rich from that first investment. The goal is to start the learning process. Third, ignore market timing completely. Invest the same amount every month regardless of what the market is doing. This removes emotion from the process and virtually guarantees better results. Fourth, build wealth outside your 401k too. Use the 401k for the employer match and the tax benefits, but don't rely on it exclusively. Build a taxable investment account where you have control over your investments. The psychology behind these lies is important to understand because it explains why they're so persistent. People want to believe that building wealth is complicated because that gives them an excuse not to do it. If it requires special knowledge or perfect timing or large amounts of capital, then it's not their fault that they're not wealthy. But the truth is much simpler and much more uncomfortable. Building wealth doesn't require special knowledge. It requires discipline. It doesn't require perfect timing. It requires consistency. It doesn't require large amounts of capital. It requires starting early and staying invested. The lies persist because they make people feel better about not taking action. It's easier to believe that you need 50 stocks than to do the work of understanding 10 companies. It's easier to wait for $100,000 than to start investing $100 per month. It's easier to believe you can time the market than to commit to a long-term strategy. Here's what I want you to understand. These 4 lies have probably cost you more money than any single bad investment ever could. They've cost you time, which is the most valuable resource in wealth building. They've cost you learning opportunities, which compound just like investments do. And they've cost you the confidence to take control of your financial future. The good news is that once you see through these lies, Once you understand what actually builds wealth, you can start making better decisions immediately. You don't need to wait for market conditions to improve. You don't need to wait until you have more money. You don't need to wait for someone to give you permission. You can start building real wealth with the next decision you make. But you have to make that decision. You have to choose between the comfortable lies that keep you financially stuck and the uncomfortable truths that build wealth. You have to choose between feeling good about your excuses and feeling good about your progress. You have to choose between the path of least resistance and the path that leads somewhere better. The market doesn't care about your feelings. It doesn't care about your excuses. It doesn't care whether you believe these lies or not. It will reward good decisions and punish bad decisions regardless of your intentions. The question is whether you're going to make decisions based on what makes you comfortable or decisions based on what actually works. These 4 lies will continue to circulate. They'll continue to be taught in financial planning seminars and repeated by well-meaning but misguided advisors. They'll continue to sound reasonable and safe and smart, but now you know better. Now you understand the difference between what sounds good and what actually builds wealth. The choice is yours. You can keep believing comfortable lies and wondering why your wealth isn't growing, or you can accept uncomfortable truths and start building the financial future you actually want. The market will be there either way, but time won't. Every day you delay is a day of compound interest you'll never get back. Let me give you some real examples of how these lies play out in practice, because understanding the mechanics makes the principles stick. Take the diversification lie first. I know someone who owns 43 different mutual funds in their portfolio. 43. They think they're diversified, but when I looked at their holdings, they owned the same large cap companies dozens of times through different funds. They were paying multiple fees to own the same stocks repeatedly. That's not diversification, that's fee multiplication. Compare that to someone who owns 15 individual dividend-paying stocks spread across different sectors. They understand each business, they collect quarterly dividend payments, and they can make informed decisions about when to hold and when to sell. Their portfolio is actually more diversified because they own different types of businesses. The $100,000 lie is particularly cruel because it steals decades from people who could be building wealth. I've seen people in their 40s who are just starting to invest seriously because they finally accumulated what they thought was enough money. Meanwhile, their 25-year-old coworker who started investing $200 a month is already ahead of them and will stay ahead of them forever, simply because time was on their side. Here's the specific math on that scenario. The 40-year-old with $100,000 who invests it all and adds nothing more will have about $460,000 at retirement, assuming 7% returns. The 25-year-old investing $200 per month will have over $500,000 at retirement. Time wins every time. The market timing lie destroys wealth in ways people don't even realize. I've tracked people who tried to time the market over 10-year periods, and their results are consistently worse than if they had just bought and held index funds. They don't just underperform by a little bit, they underperform by massive amounts because they make emotional decisions at exactly the wrong times. During the 2008 financial crisis, the people who tried to time the market sold near the bottom in early 2009, missing the entire recovery that followed. Those stocks doubled and tripled from their lows, but the market timers were sitting in cash, earning nothing. They turned temporary declines into permanent losses. The 401k lie is creating a retirement crisis that's going to devastate the middle class over the next 20 years. I've run the numbers on typical 401k balances and withdrawal rates, and the results are terrifying. Most people approaching retirement have saved less than $300,000 in their 401k. Even with Social Security, they're looking at living on maybe $30,000 per year in retirement. But here's what makes it worse. Healthcare costs in retirement are exploding, and Medicare doesn't cover everything. The average retired couple will spend over $300,000 on healthcare during retirement. If your entire 401k balance is $300,000, healthcare alone will wipe you out. The wealthy don't have this problem because they build multiple income streams that don't depend on withdrawing from a single account. They own rental properties that generate monthly cash flow. They own dividend stocks that pay quarterly distributions. They have business investments that produce ongoing income. This is why the 401k lie is so dangerous. It creates the illusion of retirement security while actually setting people up for financial disaster. The numbers simply don't work for most people, but they don't realize it until it's too late to fix. Understanding the psychological component of these lies is crucial because that's what makes them so persistent. The diversification lie appeals to people's fear of picking the wrong investment. It feels safer to own everything than to own specific things, even though owning everything guarantees mediocre results. The $100,000 lie appeals to perfectionism and procrastination. It gives people a specific target that feels achievable but distant, which allows them to delay taking action while feeling like they have a plan. The market timing lie appeals to people's need to feel in control. Nobody wants to admit that something as important as their financial future depends largely on factors they can't control. Market timing makes people feel like they can outsmart the system. The 401k lie appeals to people's desire for simplicity and security. It's easier to believe that one account managed by professionals will take care of everything than to take personal responsibility for building wealth across multiple asset classes. The framework that actually builds wealth works because it aligns with how markets actually function rather than how we wish they functioned. Markets reward ownership of productive assets over time. They punish emotional decision-making and frequent trading. They compound returns for patient investors and extract fees from active traders. Concentrated portfolios of quality companies outperform over-diversified portfolios because quality compounds and mediocrity doesn't. Starting early with small amounts beats waiting to start with large amounts because time amplifies compound returns exponentially. Consistent investing beats market timing because consistency captures all market movements, while timing inevitably misses some of the best ones. These aren't theories or opinions. These are mathematical realities based on decades of market data. The lies persist because they sound reasonable, and they make people feel better about suboptimal decisions. But the math doesn't care about feelings. The math rewards behavior that aligns with how wealth actually builds. The most important thing to understand is that these lies don't just cost you money, they cost you time, and time is the most valuable component in wealth building. Money lost can be replaced, but time lost can never be recovered. Every year you spend believing these lies is a year of compound growth you'll never get back. This is why breaking free from these lies is so urgent. Not because the market is going to crash or because some opportunity is going away, but because every day you delay implementing what actually works is a day you're moving further away from financial freedom instead of closer to it. The choice is clear. You can continue believing comfortable lies that keep you financially stuck, or you can embrace uncomfortable truths that build wealth. You can keep waiting for perfect conditions that will never come, or you can start with imperfect conditions and improve as you go. The market will be there either way. The opportunities will be there either way, but time won't. Every day you wait is a day of compound interest working against you instead of for you. Stop believing lies that keep you broke. Start following principles that build wealth. The difference between the two is the difference between financial mediocrity and financial freedom.